Okay. So in the last class, we discussed the valuation of forward contract. What is the valuation of and how we can value uh, yes, how we can value the forward contract. In that, we discussed that there are three cases in valuation of forward contract. The first case is when underlying asset does not provide any income. How we can calculate the value of forward price. And the second case is when underlying asset provide cash income. Means if any underlying asset means stock, if a particular company declare any dividend in the form of cash, then we have a separate method. And third case, I said like in when underlying asset provide income, but not in the form of cash income, but in the form of yield. So there are some underlying assets are there, like index. So if you enter the contract by taking index like Sensex or Nifty, so where in the case of Sensex, we consider total 30 companies. So Sensex consists of 30 stocks market price and it develop an index. So based on that index, we are trading. And in case of Nifty, we consider 50 stocks. So in that case, it is very difficult to identify the cash income. For example, out of 30 stock, any one stock can declare dividend in the form of cash. One or two, for example, if the three companies are declared dividend and combining cash income is not what correct way because the market price will be differ. So at that time, what we do, we calculate the yield, how much yield we got from that contract. So we convert into percentage. So that is the third case. The first case, as I said, when there is no income, when underlying asset does not provide any income, at that time, how we can calculate forward price, that is the spot price into exponential the power RT. So that is the formula we can use to find out the value of forward contract. The second case, when underlying asset provide cash income, at that time, first thing we have to find out the present value of that income. If company declare dividend after 3 months, then what is the present value of that income? So we have to discount it by using interest rate. Then we can find out what is the forward price when company declare dividend. So now today we'll discuss the third case, that is valuation of forward price. Valuation of forward price when company it has income but in the form of yield. So we are going to see third case, that is company or underlying, we can say underlying asset providing yield. So why it is yield? Why it is not dividend or interest? Because in this case, we consider only index. Sensex, Nifty, and S&P 500 in index. So if you are trading with indexes, then we do not get income in the form of cash, but we can calculate the return in the form of yield. So that's why we use the third case for this type of underlying asset. So what is the formula to find out the future price or forward price? We can say forward price here. Calculation of forward price when underlying asset gives yield. The formula is F is equal to, that is forward price is equal to spot price of the index underlying asset. If Nifty today is 13,500, then the spot price is 13,500. Spot into the exponential value, the power R minus YT. So this is the formula to find out the forward price when underlying asset provide known yield. You may ask why we are deducting the yield from this total spot price. So in the beginning, I said we calculate or we value the future and forward under cost and carry model. Cost and carry model. So here, this one, Y is nothing but income. So while calculating the forward price, what we have to do, we have to consider all the cost, whatever cost you incurred for particular contract. First add, then deduct any income derived from that contract to find out the future price or forward price. So that is the basic fundamental behind the valuation of future and forward contract. So first we have to add all the cost. Here the cost is the amount paid for the underlying asset, that is spot price. Amount paid for the underlying asset, that is spot price. Add. So if you have any extra cost, like if you are incur storage cost, if you include any storage cost, of course for index we do not have any storage cost, but just example I will explain in the future contract we'll dealing with the storage cost concept, but here we do not have such storage cost. But if you have any storage cost or any other cost, first you have to add those costs to the spot price, then use exponential values. So here yield normally they give in the form of a percentage. So therefore we have to deduct it from the rate of interest, cost of capital. So cost of capital minus yield into the term of the contract. So you can see in the second case, that is when underlying asset provide known income in the form of cash, then we deduct that particular income from the spot value. That is, you can see the second case, spot price minus and E exponential RT. We use this formula. From the spot price, we have to deduct any income. If any income you derived from the particular contract, you have to deduct it. Therefore, we are deducting yield from the cost of capital to find out the forward price. So this is the formula. We'll see one example under this case, and we'll discuss how we can find out the value of forward price. Okay. See here, one example is there. Example 2.7. Example 2.7. That is, see, assume that the stocks underlying an index provide a dividend yield of 4% per annum. The current value of the index is 520, and that continuously compounded risk-free rate of interest is 10% per annum. And find, based on this, find out the value of forward contract. First thing, read the question and identify what are the information they given to find out forward price. So we'll just write down what are the information they given. So assume that stock underlying an index. So here underlying asset is index. What index is not given, but they mention that the stock underlying asset is an index which provides dividend yield, total dividend yield of 4% per annum. So we can write y, that is yield, dividend yield is 4% or 0.04. So dividend yield is given, that is 4%. Next, the current value of the index is 520. Current value is nothing but current market price or spot price. The spot value or spot price of the index is 520. You can write spot is 520. And that continuously compounded risk-free rate of interest is 10%. So that is I, risk-free rate of interest R is equal to risk-free rate of, which is compounded continuously. Continuously compounded rate is given. We need continuously compounded rate. If the rate of interest is not given in the form of continuously compounded, if they're given in the form of simple rate of interest, then you have to convert into continuously compounded by using land values. So here they directly given the continuously compounded risk-free rate of interest is 10%. So I'll just highlight it. Okay. So 10%. And the rate of interest is 4% and market price is 520. Next very important is that find the value of 3 months forward contract. Find the value of 3-month forward contract. So therefore, the term of the contract is 3 months. You can write 3/12. So these are the information given. So based on this information, find out the value of read the detail. Just a minute. Yeah. Now, see, from the question, we extracted these details. First one is yield. Yield is given, that is 4%. Then spot price is given. Spot price of the index is 520. Risk-free rate of interest, which is continuously compounded 10%. Then term of the contract is 3 months. You can write 3/12. And now, find out the value of forward contract by using this formula. The formula is forward price is equal to spot price of the index into exponential the power R minus Y into T, the term of contract. Just insert the values into the formula. Spot price 520 into exponential value. You can write directly exponential value. In the last class I explained we have 2 ways to find out the value of exponential that is table. One is we can directly refer exponential values. Then the second way, if you do not have exponential values in your log table, then you can, by using log and anti-log, you can find out what is the exponential values. So that is lengthy procedure. If you have exponential value directly, then you can refer it. Or else you can use log and antilog, which I explained in the last class. Now, R, that is the risk-free rate of interest, 10%. You can write 0.10, 0.10 minus Y yield 4%, that is 0.04. And D is the term of contract 3/12. So first simplify it, 520 into exponential, find out this value. Use calculator for that. 0.10 minus 0.04 into 3/12. So I'm getting value of 0.015. 0.015. Now see exponential value, exponential table. Exponential table. See, I have exponential table here. The value of 0.015, 0.015, correct? 0.015. We can take 0.01 nearest value. So actually, this 0.015 lies between 0.01 and 0.02. In order to find out exact value for 0.015, we have one mathematical procedures are there, that is interpolation. So by using interpolation, you can find out exact value, but it's not what necessary to find exact value. So we can take nearest value. Here we do not have 0.015. So we can take 0.01. Or you can use log and anti-log method. Log and anti-log method to find out exact values. So I always suggest, if you do not get exact values in natural log and exponential table, use log and anti-log, even though that method is lengthy, but you will get exact value. So, but now I use nearest value. But for examination, I always suggest use log and anti-log method to find out exact value. Here I'll take nearest value, that is 0.01, and exponential value is 1.01005. 1.01005. So I can write 520 into 1.01005. Now multiply. So 520 into 1.01005. So 525.226. So that is the forward price for particular font. So 525.226. I hope you understood how to find out the value of forward price when underlying asset provide known yield in the form of percentage. Yeah. So that is all about the valuation of forward contract. In valuation of forward contract, we have three cases. The first case, when underlying asset does not provide any income, at that time we use formula of forward price is equal to spot price into exponential power RT. And the second case we have like when underlying asset provide known cash income, at that time we can find out forward price is equal to spot price minus income. Income should be in the present value uh, into exponential power RT. And to find out present value of income, income is equal to uh, the income. I
Your
use
voice
different.
is not audible, sir.
Why is this not audible? Huh? Hello, I'm not audible. Huh? Clear no voice?
Audible, sir. Now it is audible.
Audible, sir.
Audible, right?
Yes, sir.
Okay, okay,
Yes,
okay.
sir.
So second case, when underlying asset provide known cash income, when underlying asset provide known cash income, we have a formula like spot price minus income into exponential power RT. So at that time, we need to find out the present value of income, that is dividend declared after 2 months or 3 months, into the exponential minus the power RT. Dividend into or interest in case. So dividend into exponential minus RT to find out the present value of income. Then the third case, what we discussed today, that is when underlying asset provide income in the form of yield, that is future forward price is equal to spot price into exponential the power R minus Y into T. These three cases we have under forward contract. Same case will apply future contract also same, but there are one more concept we include while valuation of future contract. See, in the valuation of future contract, we divide entire underlying asset into two types. One is carry type and another one is non-carry type. Carry type and non-carry type. So what do you mean by carry type? Carry type means here underlying asset we can carry. We can carry from one place to another place. So that is the literal meaning. But the conceptual meaning is carry type means those underlying assets we use for investment purpose. Carry type means whatever underlying asset we trade, so those underlying asset, the only purpose for the investment, the sole purpose of the investment. Like we can take stock, equity shares. Equity shares we can we trade only for the purpose of investment. And then you can take bonds, debentures. You can take only for the purpose of investment. So what do you mean by non-carry type? Here, non-carry type of commodities are those commodities which can be used for consumption, which can be used for consumption, like agricultural product. So if I am dealing with, I am trading with my underlying asset is rice, so I can consume rice, agricultural products. So here, while valuation of future contract, commodities, that is underlying asset, are divided into two types. One is carry type, another one is non-carry type. Carry type are those commodities which can be used only for the purpose of investment, like equity shares and bonds. Non-carry type are those commodities which can be used for the consumption, like agricultural product, rice, wheat, barley, anything. So that is the meaning of carry type commodity and non-carry type commodities. Now, how the valuation will be differ for carry type and non-carry type of commodities. See, as I said, carry type, you can consider the gold, silver, if you are trading with gold and silver. we cannot consume gold and silver, but we require cost for storing of gold and silver. Even for even for stocks, under if the stock is in the form of materialized form, then you need some cost to uh, hold or to carry or to store. So if you incur any cost to store, hold, or carry, then we call it as a we call it as a storage cost. So based on storage cost, again in the valuation of future contract, we have three different cases. At the first three case we discussed in the case of forward contract will be applied here also in the valuation of future contract. Apart from that, if any information which is related to storage cost is given in the question, then you have to think these formula also. If there is no storage cost is given in the questions, then you can apply same formula as we discussed in the case of forward contract. But if storage cost is given, then you have to see at what case we can deal with particular case. Now here, first we'll discuss how to find out valuation of future contract for carry type of commodities. Later we'll go for valuation of non-carry type of commodities. See, here also, if first case when the storage cost is zero, that means if there is no storage cost, then you can use this formula directly, which is similar to first case of forward contract. So if you see the first case of forward contract, F is equal to spot price into exponential power R is same. If there is no storage cost, then there is no issue. You can use directly this formula. And when there is storage cost and which is given in cash, then forward price is equal to spot price of the underlying asset plus storage cost is given in the form of cash. For example, if the spot price is 100 and storage cost is 5 rupees, then 100 plus 5, 105, then use exponent, everything will be same. Risk-free rate of interest, then term of contract. When storage cost is given in the form of cash. And third case, when the storage cost is given in the form of percentage, then you can go for this formula. That is F is equal to spot price into exponential exponential into power R plus here see yes, that is storage cost in the form of percentage. This one is risk-free rate of interest and T is the term of contract. So these are the three cases you have to consider if the storage cost is given. The first case when there is no storage cost, and the second case when there is storage cost is given in the form of cash, and when storage cost is given in the form of percentage. So this is for carry type of commodities and non-carry type of commodities. So here non-carry type of commodities, we have a separate formula and we value such commodities under convenience model. Because we do not get any return and here it does not give any expected return underlying asset rise or wheat. So here we use convenience model. What do you mean by convenience model? See, you know the meaning of forward contract and future contract. If I am the buyer and sorry, if I am the seller, Mr. A is the seller. So Mr. A has what commodities? Like take example of rice. He is the farmer. Mr. A is the farmer, and he crops and he get the yield. And I and Mr. A made contract that after 2 months I will purchase that rice for a certain price. So here the seller get a convenience. What is the convenience? Convenience means so within that 2 months he can hold that commodities. He can hold that commodities as well as he can use it for consumption. He can use it for consumption. He get convenience of investment as well as consumption. Of course, it is very difficult to measure such aspect, that is a behavioral aspect. We in research we call it as a qualitative approach. The convenience, the benefit derived from the particular things, the measurement is very difficult. The return from particular stock we can compare closing price minus opening price divided by 100. Divided by opening price into 100. So we'll get return. That is a quantitative approach. Quantitative, there is a measurement, perfect measurement are there. But for the measurement of convenience, a benefit, or perception, all such concept, the measurement is very difficult. So at that time, we use some approach and we convert into in the form of percentage. We use any method. But here also, if the convenience is given in the form of what percentage or in the form of proportion, then what is the formula? So if the convenience yield is given, store along with the storage cost, if there is a convenience is there, then stock price or spot price plus storage cost into exponential power risk-free rate of interest minus convenience yield into T. Then here F is equal to, this one is when the convenience yield is given in the form of proportion. And the convenience yield is given in the form of proportion. We can use this form. So these are the keys we have separately in the valuation of future contract. Along with these three cases, we have to consider these cases for the valuation of future contract. Yeah. Now we'll see some of the example which given in the semester examinations. We'll discuss how to value forward contract and future contract. Here I have one question bank is there. If you need, you can take a print of this one. You can take copy of it. Anyone come here and collect and take copy of it. I made one question bank is there. So we'll discuss the problems here related to future contract and forward contract. Okay. First, okay, here one problem is there. That is, I think it is visible now. See, fifth one, calculate. Here also is there one more. First, we'll discuss this one. Calculate forward price if current market price of the asset is 75. The risk-free rate of return is 12% per annum, and time to expiration is 9 months. And dividend expected rupees 2.2 per share for 4 months. So read again. See, calculate the forward price. If market price of the asset is 75, the spot price is 75, and the risk-free rate of return is 12% per annum, and time to expiration, that is maturity period of the contract, or we can call it as a term of contract, T is 9 months, and dividend expected is rupees 2.2 per share. That is for 4 months. The dividend will be declared after 4 months. Calculate the price of or forward price. The first thing you have to do, you have to identify what type of case. So we discussed 3 case. You can call it as a 4 case. The first case, when there is no income, you can see we have income, that is dividend expected rupees 2.20, dividend is given. And the second case, when there is dividend given in the form of cash, we can see here dividend is given in the form of cash, that is rupees 2.20, not given in the form of yield or percentage. So we can confirm that this one is belong to second case, that is when underlying asset to provide no cash income, correct? Because the dividend is given 2.20. So this is the second case of calculation of forward price. At that time, you should know what is the formula to find out the forward price under second case. So first we'll write down the given information. That is spot price is given. Spot price how much? Spot price of the asset is 75. Market price 75. Then risk-free rate of interest. Risk-free rate of interest R is given 12%. 12% per annum. And the time to expiration, the term of the contract, you can write TC. Term of the contract, TC. That is, time to expiration is 9 months, 9 by 12. 9 by 12. And dividend is expected to rupees 2.2 per share. That is given in the form of cash income, rupees 2.20. Rupees 2.20. And the term of the dividend will be declared after 2 months, after 4 months. So term of the dividend TD is 4 by 12. Term of the dividend is 4 by. So with this detail, find out the value of forward price. Calculate forward price. So first I will write the formula. Under second case, when underlying asset to provide no cash income, the formula is F is equal to spot price. From the spot price, deduct income, that is dividend. Spot price minus dividend into exponential power RT. So that is the first formula to find out forward price. Spot price, current market price, which is given 75. Income is given, dividend is given 2.20 per share. That is after 4 months. But we need the present value of such dividend. So here we have one more work, that is to find out the present value of dividend. So what is the formula to find out present value of dividend? So I is equal to dividend into E, the power minus RT. Dividend into E minus RT. So first we will find the present value of income. Then we'll go for the forward price. So I'll use this formula to find out present value of income. So dividend amount is given. Dividend is 2.20. So I'll write 2.20 into the exponential power R risk-free rate of interest is 0.12 into the term of the contract. So what is the term of the contract? That is 9 by 12. Can use 9 by 12 minus 0.12 into 9 by. So use calculator and find out 2.12 into 9 by 12. 2.20 into E, the power minus 0.09 minus 0.09. Check out exponential table value and see what is the value of. Yes, 0.09. Here it is 0.09 and e the power minus x, fourth column, 0.09 e the power minus. So here value 0.91393, right? Zero point 2.20 into 0.91393. 2.20 0.931393. So 2.20 into 0.91393. So present value of income is 2.01. 2.0106 you can take. We'll take approximately 2.01. The present value of income. Now find out forward price. Forward price, that is using this formula. Spot price minus income into exponential power RT. So what is the spot price? Spot price is how much? Spot price is given 75. And the present value of income, so that we already calculated 2.01. Deduct it, 2.01 into the exponential power R, how much? Same 0.12. Sorry. Here one mistake. See, this one, while finding out present value of income, we should not consider term of the contract. T means here for dividend. So this one is term of dividend, not term of contract. So this is 4 by 12, not 9 by 12. Sorry for that. 0.12 into 4 by 12. So we'll get 0.04. 0.04. See, the value for 0.04 is 0.96079. 96079. This one 0.96079. Here, not term of contract, it should be term of dividend, which is given. Term of dividend 4 by 12. So 2.20 into 0.9607. So dividend 2.114. You can take 2.114. 2.114 into, here you can use now 75 minus 2.114 into exponential r same 0.12 12%. And here we have to take term of contract. Term of contract is 9 by 12. Term of contract is 9 by 12. So now find out first 75 minus 2.114, that is 72.886 into the exponential 0.12 to 9 by 12, it is 0.09. 72.886. Now again find out the value of 0.09. 0.09, sorry, here 0.09, but e the power x, that is third column, value 1.09, right? So 72.886 into 1.09417. 72.886 into 1.09417. Now multiply 72.886 into 1.09417. 79.75. 79.75 is the forward price for this contract. Clear? First, you need to discount, or you have to find out present value of income. Then you have to find out forward price. Okay. I hope you understood. Next, we'll see next problem. First, read the question. See, calculate the value of stock index futures using following data. Stock index future. So index is given, index does not provide any income in the form of cash. So it provides income in the form of yield percentage. So you can directly think about it should belong to third case. But we'll see more details to confirm which type of case this particular problem. So now calculate the value of stock index futures using following data. Assume that the spot value of the index is 3090. The spot value of the index is 3090, and the continuously compounded risk-free rate of return is 8% per annum, and time to expiration is 76 days. Find the value of futures contract. Find the value of future contract, assuming multiplier to be 100. As we discussed in the case of, while discussing the meaning of future contract and forward contract, the difference between forward contract and future contract. See, in future contract, everything is standardized. Everything is in standardized. Means here in future contract, the trader cannot trade in any quantity other than mentioned in the stock market. So everything will be specified by the regulator body, that is stock market. The quantity, the quality, the price, everything in the future contract. So there is one concept called lot size. You know the concept of lot size. For one contract, there will be lot size. So in this case, see the entire question. Assume that the spot value of the index is 3090. That is the current market value of the index is 3090. And continuously compounded risk-free rate of return is 8% per annum. And time to expiration is 76 days. The term of the contract is given in days. So if the term of the contract is given in the days, that's no issue. Just 76 divided by 365 days. If it is given in months, then particular month divided by 12. So here the term of the contract is given in the days. So while using the formula, make it 76 divided by 365. Find value of future contract, assuming the multiplier to be 100. So why it is 100? What is the importance of 100? So here, this one is given 3090. 3090 is the price for 1 unit. The price for 1 unit. So while finding out the forward price, you have to multiply 100 to find out total value of the contract. So this 3090 is for 1 unit, or for index we can use unit, we cannot use stock. So for 1 unit, that is 3090. For 100 unit, how much? So just multiply to find out the total value of the contract, spot value. And continuously compounded rate is given 8%. Time to expiration is given. So using this information, find out value of future contract. Here also first find out what type of the case. Your underlying asset is there, that is index, which does not provide any income in the form of cash, but which they given, see whether they given any rate of interest. So here no yield is given. No income is given in the form, either in the form of cash or in the form of percentage. This one rate of return is not a return from the underlying asset. This one is the risk-free rate of interest. What is the risk-free rate of return? Instead of investing this particular contract, if I invest in any risk-free investment avenues like savings bank account or treasury bills, so I can expect 8% return. So why are we using this concept here? Because we use opportunity cost concept. Instead of investing in this particular if I invest a risk-free investment avenue, what is the rate of return I can expect? That is 8%. This return is not return from the underlying asset, remember. So here there is no income given which we can expect from the underlying asset. So no income which comes first case. So here we can use the underlying asset does not provide any income. So that is the first case. Now first I'll write the given information. The first one, first information, assume the spot value of the index, that is spot price of the index is 3090. And next one, the risk-free rate of interest compounded continuously 0.08 or 8%. The term of the contract is 76 days. 76 divided by 365. Then lot size is given, lot size multiplier 100. Lot size is 100. And there is no other information is given. no dividend, no yield. So we can consider this one is belongs to first case when there is no income. Now, what is the formula to find out uh, future price under first case? And here we have to consider whether there is a storage cost. Storage cost is also not given, and there is no dividend also. There is no income also. So we can directly use the first case, that is future price. Future price is equal to spot price into the exponential power RT. Spot price into the exponential power RT. The first case, to use formula, spot price 3090 into exponential value, the power RT 0.08, term of the contract 76 divided by 365. 76 divided by 365 days. First simplify it, 0.08 0.08 into 76 divided by 365. 3090 exponential over 0.016. I'll make it a 17. 0.017. See here, we are not getting an exact value, 0.017. So here in this table, normally we do not get such values. We'll get exact value only, 0.01, 0.02. There is no value 0.017. So as I said, we can use 3090. How we can use anti-log of 0.017, then log of 2.7183. So this method you can follow to find out exact value. I said use this way to find out exact value, but this take time as we do not have time now. So I'll directly take this value 0.01. The exponential value is 1.01005. So 3090 into 1.01005. 3090. Yes. Find out value 3090 into 1.01005. P12105. So that is the future price of that contract. Now, if you have any doubt, you can ask. Students, if you have any doubt, now you can ask. We'll discuss some more problem. If you have any doubt, you can ask. No doubt.
No, sir.
Okay. See here, we have one more problem is there. I'll just explain it. The calculation is very simple here. First thing, you have to understand what type of case it is. Then you should know the formula. Then application. The calculation is very simple. If you have a log table and if you know how to calculate it, Then very simple. So I'll explain the problems. I have question bank. I'll explain how to deal with it. Then if you get time, please work out and prepare a note for that. Okay. So here, consider a 3-month future contract on NSE 50, that is one index, NSE 50. Assume that spot value of the index is 1090 and the continuously compounded risk-free rate of return is 12% per annum. And continuously compounded yield on shares underlying the NSE 50 is 4% per annum. Find the value of future contract assuming the multiplier to be 200. So can you tell me which type of case it is? Can anyone tell me what type of case it is? Just look at the question. So we have 3 cases. First case, there is no income. Second case, when there is cash income, and third case is yield. Which type of case it is?
Third case.
Yes, it is third case because we can easily see that here directly given yield, compounded yield. So the formula to find out future contract is equal to spot price into exponential power r minus 5 into t. So this is the formula. The spot price is given. The value of index is 1090 into exponential. The power, the risk-free rate of return continuously compounded is 12%. That is 0.12. And yield is 4%, that is 0.04. The term of the contract, see the term of the contract were 3 months. So 3 months future contract, 3-month future contract. So 3 by 12. See, multiplier is given in the previous case also, multiplier is given. Here multiplier is given 100. Either you can multiply here only 3090 into 100. So 30,900, I guess, yeah. Or you can multiply finally for the forward price. So it is always better to multiply for 3090 into 100 multiply. Then get 2 zeros, right? Yeah, 3,09,000. Then multiply. Here also 1090 for 1 unit and multiplier is to be 200. Multiplier to be 100. So 1090 into 200. So 2,18,000. 2,18,000 is a present value. Then use this one. Risk-free rate of interest, yield 4%, 0.04, and term of the contract. Simplify it. See the exponential value. If we do not get exact exponential value, use log and anti-log and find out exact value. Then multiply to this one. We'll get future price. Next. Yes. See here. One more problem is there. B. The risk-free rate of interest is 9% per annum with continuously compounding, and that the dividend yield on stock index varies through the year. So here yield is given, but not fixed yield is given. It varies throughout the year. The first one is given, that is the risk-free rate of interest. Risk-free rate of interest is common, that is 9% per annum. And with the continuously compounded dividend yield throughout the year, that is given in February, May, August, and November. Dividend are paid at the rate of 5% per annum. And in other months, dividend are paid at the rate of 2% per annum. Suppose that the value of index on 31st July is the 1300. What is the future price for contract deliverable on 31st December of the same year? So first I'll write the given information. The first detail is given risk-free rate of interest, that is 9% per annum. And there will be a little confusion about yield, because that will vary throughout the year. And the next information specifically given, that is the spot value of the index 1300, and the term of the contract. So calculate the term of the contract. Suppose that he entered the term of the contract also is not directly given. If you look at the entire problem, there is no information about the term of the contract, but they given him like, see here, suppose that the value of the index on 31st July. So that means on 31st July, he entered the contract, and what is the future price of the contract deliverable on 31st December? So he entered the contract on 31st July, and he will deliver that underlying asset on 31st December. So you can calculate the term of the contract. So what is the term of the contract? From 31st July to 31st December. That is August, September, October, November, December. So total 5 months. So term of contract you need to find out from 31st July to 31st December. So you'll get the term of the contract is 5 months. The term of the contract is 5 months. How? From 31st July to 31st December. Calculate. Then now about yield. Say the information yield. No fixed yield is given. They stated in February, May, August, and November, dividend are paid at the rate of 5% per annum. And for the rest of the months, the dividend are paid at the rate of 2% per annum. So here we need, for the calculation of forward price or future price, we need one fixed rate of yield. So what we can do, we can find out the average dividend distributed or dividend provided. So how we can find out average dividend when the dividend rate fluctuates throughout the year? So here, see in February, May, August, November, dividend are paid at the rate of 5%. So that means for how many months they paid at the rate of 5%? 1, 2, 3, 4. For 4 months, they given at the rate of 5%, and remaining 8 months they given at the rate of 2%. For 4 months they given dividend at the rate of 5%, and for 8 months they given at the rate of. Now we cannot find out simple average. We cannot use simple average for this type of case. What is the simple average? 5 plus 2 divided by 2. That is wrong. We cannot find out simple average to find out average of yield. So we need to find out weighted average. Because 2% is given for 8 months and 5% is given for 4 months. So we can 4 into 5, 20, then 8 into 2, 16. So total 36. So 36 divided by 12. How much? 3%. See, if you take simple average, 5 plus 2, how much? 7. 7 divided by 2. So that is 3.5. So we should use weighted average for 4 months 5%, for 8 months 2%, so you'll get 3%. So yield is 3%. So once you get the yield details, then you can go for calculation of forward price. So that is F is equal to spot price into the exponential power R minus Y into T. So this is the formula. 1300 into exponential, the power R, how much? Rate of interest 0.099%. Yield that we calculated 0.033%. Then term of the contract we calculated, that is 5 by 12. 5 by 12. Simplify it, find out exponential value, then multiply it to the 1300. You will get future price. Understood?
Yes, sir.
Here also one problem, is very simple problem. What should be the value of 6-month forward contract of a share if it is holding in the cash market or at rupees 100? Cash market is nothing but a spot market. The spot price of the underlying asset is 100 and the contract is for 6-month forward contract. The share is expected to declare dividend of rupees 4 after 4 months. So first thing you need to identify what type of case it is. So dividend is given and that is also given in the form of cash, rupees 4. So we know that that is a second case. When underlying asset provide known cash income in the form of cash, that is 4. But that will be declared after 4 months. So when such information is given, you should understand the first thing we need to do is to find out the present value of such dividend. The present value of such dividend by discounting. Same second case formula as we discussed, like here, I'll write. Same formula for second case. Forward price is equal to spot price, income, exponential power RT. Income is given, but which will be declared after 4 months. So need to find the present value of dividend, E minus RT. So dividend, how much? Dividend is 4 to exponential minus R, how much? The rate of interest in the economy is 10%. So 0.10. And see, for T, the term of dividend is after 4 months they declare dividend, 4 by 12. So first find out present value of this dividend. After that, use this formula to find out forward price. So R is same, that is 0.10. T is same 4 by 12. Spot price is 100. Spot price is 100. For example, if we are get to 3.70 something, then 3.70 into exponential R 0.10 T. Term of contract. So what is the term of contract? 6 months. 6 by 12. Next. See here, question 8. A forward contract of a non-dividend paying, directly given non-dividend paying stock. So very easy to identify the case. That is the first case. The underlying asset does not provide any income. Forward contract non-dividend paying stock is to be mature in 3 months time from now. The stock is currently selling the market price, current market price 1,700. Contract is for 3 months and risk-free rate of interest 10% compounded. Can't find out theoretical value. See, theoretical value and intrinsic value and future price will be same. That is by using whatever you calculate the value by using formula, that is intrinsic value or theoretical value. So don't confuse with the term used at theoretical. Theoretical means intrinsic. Intrinsic means by using formulas. Future price of the contract. First case, all information directly given. Use formula like this. We'll get the value. Here, the risk-free rate of interest is 9% per annum with continuously compounded, and that the dividend yield on this stock index varies throughout the year. In February, same case as I explained now. So first you need to find out average yield by using the weighted average. Then you can use third case, that is yield method. Same, very simple from the valuation of forward and future contract. So you can expect very simple problems. So here also calculate forward contract price 6-month contract. Contract share price expected to pay dividend during a period which is available at 75. Dividend amount is 70. No dividend. Sorry, is expected to pay no dividend during the period which is available at 75. 75 is the market price which does not provide any income dividend. So given that risk-free rate of interest is 8% per annum, what strategy you would frame if actual future contract price is 87 and 80? So this one is some practical questions. First, you need to find out what is the theoretical value, intrinsic value. Then you have to give conclusion. What strategy you would frame if the actual future contract price is 87 and 80? That means whether you take a long position or you take a short position. See, I'll just explain how you can answer this question. First thing, very simple. First, you need to find out the intrinsic value using the first case, that is forward is equal to spot price into exponential power RT. Use this formula. Then, for example, if you get the value of 82, consider value of 82. Intrinsic value is 82. Intrinsic value is 82. Then, what is your decision? What strategy you would follow if the actual future price is 87? That means intrinsic value is less, but the actual price is more. That means in the market, that particular contract is overvalued. Its real value is 82, but it is available for 87. Then at that case, I should go for short position. I have to go for short position. And because we know the concept of fundamental, that is the market price of the underlying asset or any investment will reach or will walk to the intrinsic value. We'll walk to the intrinsic value. So in the future date, it definitely reached to its intrinsic value, that is 82. So it is better now I have to go for short position at rupees 87. Then when market hit for 82, I have to repurchase it and make profit of rupees 5. And in the case of 80, if in the case of 80, then it is reverse because the real value is 82, but it is available for 80, means undervalued in the market. We know that in the future date, it will go till 82. So what I have to do, I have to take long position. Long means buying. You have to buy a future contract at rupees 80, and you can take, you can keep target for 82. 82 is your target. So you can make profit of rupees 2. So this strategy you can follow in this two different scenario. And here one more is there. 1 year forward contract non-dividend entitled to stock price 150, risk-free rate of interest is 6.5%. Use arbitrage. Sorry, this one is it not. Okay. See this one. Two dividend payments of rupees 15 each are due from shares at the end of second and 6 months from now. The share is selling at rupees 1,120. An investor has to take a short position in the 8-month forward contract now, assuming continuously compounded risk-free rate of interest 12%. Determine the price at which investor would have entered into the contract. After 4 months from now, if the share is quoted rupees 115, what would be the forward price and the value of the contract entered by the investor? Assume the risk-free rate of remains the same. So there is two dividend payments, rupees 15 each, are due from share at the end of second and 6 months. Here there will be two term of dividend. So while calculating the present value of dividend, you need to calculate separately. First find out present value of dividend, which will be due for second month. And the next, find out present value of dividend, which will be due for 6 months. After that, you add both the present value of the dividend to find out what is the total amount of dividend. Then deduct it from the total cost. That is, see the share price is 1,120. 1,020. This one is particularly a case of second case. The only difference is here the dividend declared at 2 times throughout the contract. That is, one is after 2 months and second one is after 4 months. So now, assuming that continuous compounded risk-free rate of is 12%, determine the price that we know to have contract after 4 months from now if the share is quoted. So 1,1145. Current market price 1,112, and investor had taken short position, and determine the price at which investor would have entered into the contract after 4 months from. So this one is one case here. The share is selling at 112 now. Investor has taken short position. So this one we'll discuss. So little complication is there. Yeah? So first write down two dividend. So I'll write this one. Contract. Consider this one is the entire contract. Entire contract. We don't know the term of the contract or the date of the contract. I'll take, just for hypothetically, I take Jan 1 as a first date, and the total of the contract. Okay. For 6 months, so I'll take July 1st. July 1st. So from Jan to July, my contract. So here, after 2 months, I'll get one dividend. After 2 months, there will be one due. After the due from second and 6 months. So here, first dividend, I'll get first dividend after 2 months. And second and 6 months from now. After 6 months, after 6 months, okay, I'll get take here. After 6 months, I'll get a second dividend, dividend 2. So this is the case they given. Total contract 6 months, and about dividend after 2 months, I'll get one dividend, and after 6 months from now, I'll get one more dividend. Now see the case. Assuming that continuously compounded rate is 12%, that is, there is no difference. First question, here there will be two questions. First question, determine the price at which investor would have entered into the contract. So that is nothing but by taking this case, find out the price, forward price. That is F is equal to spot price into, spot price minus income e the power RT. And while calculating I, dividend, first dividend will be calculated, that is rupees 15 into e the power minus R is 2 into term of contract is 2 by 12 plus 15 to e the power minus 0.126 by 12. Clear? First one is for 2 months and next one is for 6 months. Combine whatever amount you'll get, that is the present value of income. Then use this formula and find out forward contract. So that is the answer for the first question. Answer for the first. The second question they asked, after 4 months from now, if the share is quoted rupees 1,115, what would be the forward price and the value of the contract entered by the investor? So after 4 months from now, after 4 months, that is from here. So after 4 months from now, here, if he entered into contract at this point and the market price 1,115, from here, you consider from here, what would be the contract price or forward price? You can see here, after 4 months, then remaining only 2 months, and there will be one dividend you will get after 2 months, that is 15 rupees. So in the second case, while calculating present value of income is equal to 15 into exponential e 2 by 12. Only one case. Then forward price, apply spot price minus income e the power RT. So this is the answer for the second question. A spot price here 1,115. Here spot price is 1,120. Here 1,115. Here 1,120. Find out forward price. Now, there are many similar problems you can expect. Just repetition are there. Now, if you have, you can refer textbook as I already uploaded. That is Future and Option by N.D. Orr and B.R. Bagri. You can read that book. That is actually a good book. You can read that. So at that time, if you find any difficulties or if you have any doubts, then you can ask me. So we can discuss about that. I hope you understood the valuation of forward contract and future contract. So in the next class, we'll discuss about mark to margin, how to calculate mark to margin. So here, like as I said, in the future contract, both the parties while entering into the contract, they have to keep money in the stock market as a margin. We call it as a margin. So why normally uh, stock market or Security Exchange Board of India, they will ask money because to set off the profit or loss on daily basis, your the stock market, they will deduct whatever the loss made on the daily basis and they add profit. So that concept, particular concept is called mark to margin, mark to margin. In the next class, we'll discuss how the mark to margin will operate in the stock market with the practical problems. If you have any doubt, you can ask, or else I'll wind up here. Okay. Thank you. Thank you, student.
Thank you, sir.
Thank you, sir.
Thank you, sir. Thank you, sir.